be looking at on audit strategies. So section 2 speaks to the summary of audit strategies, and that's what we'll be discussing in this second unit. All right, so this second section, not unit, we're still on unit 1. We're looking at the summary of available audit strategies. And we have the strategies around what we just spoke to in the first unit. And we understand that auditors can adopt different strategies depending on the client's size, the systems, the risks of the client. So each of the strategies have their own strengths and their own limitations. So also organizations have their strengths and their weaknesses and areas that must be covered. And if you look at the questions from Grace and the question from Samuel, they resonate perfectly with this slide. So your strategy will depend on the client's size, the client's systems, and the client's risk. And the statement of financial position approach focuses on year-end balances using substantive testing, which is very important. So year-end balancing or year-end balances based on the logic that if the opening and closing balances are correct, then the profit and loss or the statement of comprehensive income is fairly stated. So based on these premises or this premise, we can logically state that if the opening and the closing balances are okay, especially for a small entity, then we can conclude based on the statement of financial position approach that the financial statements or the position statement, the performance statements are fairly presented or fairly stated. So for example, in a small retail shop that we used, because the statement of financial position approach resonates more with small entities. In a small retail shop, auditors mainly test year-end cash, inventory, and payable balances rather than test all the transactions. So the statement of financial approach resonates more with smaller companies and could capture the essential issues that would help you gather sufficient and appropriate evidence to be able to provide your audit opinion. Then for the substantive testing approach, you see now we are going from down to top. The substantive testing approach speaks to applying detailed tests to a large number of transactions. So this speaks more to larger companies, mid-sized companies, and the detailed tests of the number of transactions and balances is where you use the substantive testing approach, and it's useful where internal controls are weak or absent. Some may be common also in smaller entities. You can use substantive testing approach for smaller entities where their transactions are a bit much. And the drawback of this substantive testing approach is that it's time consuming. It's also costly because the risk of testing immaterial items, because you will not sample here now, you have to test a larger population. And the risk of testing immaterial items may make you miss unrecorded transactions. So an example is a startup with weak controls. Auditors need to verify all invoices and receipts for revenue. And that's where substantive testing will come in, depending on the size and nature of the business. Then for the system-based approach, you need to it focuses on testing controls in client systems that generate financial information or culminate in production of the financial statements. The reliance on controls requires some substantive testing due to control limitation. And often you combine it with analytical procedures. Analytical procedures in the sense that you go into some details to see how some of those postings are done. And it's more cost effective than the substantive testing because auditors could over audit areas with strong controls. And where you have strong controls, there's no need to overflog the horse in that place. So for example, in a bank Auditors test loan approvals, controls, and rely on system integrity with sample checks on loan balances. So this approach resonates more with high-tech organizations like banks. Very, very key. So take note of that. Then for the risk-based, which is the business approach, it starts with identifying. You have to sit down, especially at the planning stage, to identify areas that most likely to have material misstatement. High-risk areas get extensive testing. So the risk-based approach could employ any of the first three we've looked at. You could employ the substantive, the system-based, to do high-tech or high-value analytics. And it ensures you focus on what really matters for the audit opinion. So the material areas. And for example, in a manufacturing company, auditors will need to focus on inventory valuation, heavy high-tech inventory-based company are high-risk areas where auditors need to focus their attention on to be able to get sufficient and appropriate evidence to produce their audit opinion. So the key takeaway is that no single approach is used in isolation. So take note of it based on the questions that came in the first session. No single approach is used in isolation. In practice, auditors often combine strategies to balance efficiency and also produce assurance. What you are doing is you are giving assurance, and your assurance must be based on appropriate, sufficient evidence. So no single approach is used in isolation. You can use several approaches, synergize them just to have your evidence and balance efficiency and provide reasonable assurance that the financial statements are fairly presented. All right, so that's it for Unit 2 and or Section 2, I beg your pardon. Okay, I think there's a statement here. For instance, a system-based audit may still include substantive tests in high-risk areas. Yes, exactly. So where you have a high-tech business or company, you may still include substantive testing approach based on the system-based. Maybe they don't know how to use the ERPs. You found out there are some deficiencies. You may need to test some of those postings and high-risk areas to validate what was posted. All right, so that's the summary of available audit strategies we've looked at briefly. Any questions based on this? I believe it has provided clarity to the first section we looked at. Any questions, contributions, observations? All right, I believe there's none, so please interject freely if you have issues. So the final section on Unit 1 speaks to the factors in the choice of audit strategy. What factors do we consider in choosing the audit strategy you want to employ for the audit? And you must understand that the audit strategy choosing depends on several factors. Understanding these factors helps auditors decide which approach will be most effective and efficient in carrying out their work. Number one, the first factor is the nature and size of the client. So for large companies, often require business risk approach. Yes, like we said earlier, bigger companies, banks, listed companies, PLCs require a business risk approach because as risks are complex, they are also wide-ranging. They are wider. So you need to employ the business risk approach because the size of some banks are very, very big. So the business risk approach will resonate more with that company. And for smaller companies, a statement of financial position approach is often most practical because records are quite simple and they are not complex. For example, a multinational bank, the risk-based approach would help, or business approach for a multinational bank. But a small little shop, the statement of approach or financial position approach will suffice practically for auditing such a company, a small shop. Then another factor you need to consider is control procedures. and the business environment. How are internal controls? So for strong internal controls, in assessing the factor of control procedure and environment, a strong internal based or internal control system should employ the system-based approach. This is suitable because you have reliance and you can place your reliance and comfort on those controls. So the control procedure and environment is also a factor to consider which approach should be employed for that audit. And where you have no controls or weak controls, the substantive testing approach becomes very necessary. So for example, a telecommunications company with automated billing system may use the system-based approach, or the auditors may use a system-based approach to audit a telecoms company, because most telecoms companies are highly automated in their recognition of bills, their revenues, and most of the parameters or the areas that involves their financial reporting. So the system-based approach would help auditors to address the areas of audit for a telecoms company. Then another factor is the audit firm's methodology and preference. What methods do the audit firm gravitate towards? So for larger audit firms, the Big Four often prefer risk-based approach. Yeah, this is true. So I've worked with them for a while. The Big Four normally gravitate towards the risk-based approach, aligning with international standards. The risk-based approach actually is the international standard and the recommended audit approach, and it helps you efficiently and effectively audit. So the Big Four or the big firms gravitate towards this approach. So the audit firm's methodology and preference is very important. It's also a factor that will influence the kind of approach or strategy they employ. So for smaller audit firms may rely more on substantive or the statement of financial position approach. Looking at the kind of clients those small firms attract, they will hardly attract big clients. So most of them would restrict their approach to either substantive or SFP approaches. So an example here is the Big Four firm audits a listed oil company. Mostly they will not use SFP approach. They will use a risk-based methodology approach. So the tip is that in the exam, if asked to choose and justify an audit strategy, always consider the factors like the size of the entity, the strength of controls, and the audit firm's approach. These are three factors you should be able to speak to. The size of the entity you are auditing, the strength of the controls, and also the audit firm's approach. This is very, very important. So you need to also justify your choice clearly with these factors. So whatever approach you want to employ, we need to justify them clearly based on these factors. All right, so that will be the end of the statement of, that will be the end of this third unit, speaking to the factors that influence the choice of the audit strategy. So do we have any questions based on this? Any questions? Any contributions? Any observations based on what we just looked at? Any questions? All right, so if we don't have any questions, then we'll be moving to Unit 3, speaking to the business risk approach. And, yes, please. Go
Hello,
ahead.
Sir.
Yes, please. Yes, please.
Okay, sir. This approach and strategy, are they the same thing?
Exactly. An approach is also a strategy. The way you do something, how you want to do something is an approach. Also, the strategy on the direction. So when you say approach and strategy, you are talking about the same thing. Exactly.
Okay. Okay.
Yeah.
Thank
Yeah. All right. You're welcome. Okay. So let's look at the business risk strategy or the business risk approach. which is the second unit. And this speaks to the development of audit strategy and practices. We also look at the meaning of the business risk approach. We also look at the nature of the business risk approach. We'll also look at internal business risks and external business risks. And we'll also look at another section on risk evaluation. And we'll look at the advantages and disadvantages of the business risk approach. Finally, I think the seventh one will be comparison of business risk and financial statement risk. Quite a long unit, but then it will provide context to what we need to understand what we've just looked at. Okay, so the development of audit strategy and practices. Audit practices have evolved over time due to the growing size and complexities of businesses. And the need for greater efficiency has prompted audit practices to be able to employ audit strategies in their the quest to have good audit output. So for the substantive testing approach, which is employed mostly at the early stage, heavy reliance are placed on testing transactions and balances directly. So the weakness with this approach is that it is time consuming because you test a lot of that data and you have large bank of data, then it's going to be time consuming and challenging. And also less efficiency for large and complex companies where you have big data, heavy, complex data. It will be time consuming to test all of them. So the substantive testing has this weakness. But the system-based approach is a shift in practice because the focus moved to testing internal controls because it's the internal controls that produce most of the output. So this shift from the substantive testing approach to system-based testing, especially where ERPs are involved, focus and relies less on substantive testing. It relies more on internal controls and less on substantive testing. So if systems and controls were strong, auditors could reduce their detailed testing. So for example, like I said, currently we use Tally ERP9. If every transaction is posted and is posted rightly on the Tally, the production of the financial statements is simple. You don't have an issue. So you don't have to test what is posted and what is generated as financial statements. So system-based approach is a good approach, especially where the organization is tech savvy and employs a lot of technological tools to produce their financial statement. It will reduce detailed testing. So for example, the automated payroll controls we looked at reduce the need for testing every pay slip to see that there are no ghost workers or people's staff were paid salary. So you don't need to test every pay slip from the from the ERP. Once payroll is automated, it reduces the need for this. And this will cause a shift, and the shift will be effective and efficient in the area of moving from substantive testing to the system-based approach. And the third one, which is very important, is the risk-based audit approach. It's a further development where auditors concentrate work on high-risk areas and is guided by the audit risk model. Like I said, speaking to the inherent risk, talking about susceptibility of an account to error or fraud. Inherent risks are always there. And we also have the control risk, the likelihood controls fail to detect or prevent error. And the detection risk, which I said was the residual risk, is the chance the auditor fails to detect material misstatements. So the audit risk is addressed by the risk-based audit approach. The three audit risks, for example, focusing on revenue recognition in a fast-growing tech company, which is a high inherent risk, the audit risk model could be employed, and the risk-based approach will help address this concern. And this strategy or model will help to focus on high-risk areas especially, for example, a tech company. Then the business risk approach, which is the latest practice in large firms, looks at strategic business risks that may impact financial statements and the going concern, the future existence of the business. So the business risk approach is actually for larger firms. So the strategy the big four uses, because most of them are the ones that audit these big or large companies, they use it to look at areas of financial statement impact and also the futuristic operations and the sustainability of the business. So it's broader than financial misstatement because it considers threats to the entity's ability to achieve its objective. So not just looking at the financial statements and the production or the fair presentation of items, it goes beyond that to look at issues, risks, threats, most of them external to the entity and the ability to achieve their objectives. So, for example, the loss of a major customer for a telecom company could be a major challenge, a major business risk issue to a telecom company, where a customer provides a large chunk based on a contract of a telecom company from their revenue, could signal a going concern matter that external auditors could flag. It's not just the financial statement. So these areas are areas that the business risk approach would employ to be able to add value and provide assurance to the owners of the company. Another example is sharp rise in oil prices affecting an airline is an example. So there was a time we had issues with rising prices of airline gas or something, and you can see the soaring prices of tickets was just going up that time. So in auditing such an airline, this risk, looking at the prices or the oil prices, the automotive oil that we use to fly airplanes, could be a risk that auditors could look at, and the prices that could bedevil the operations of that airline if not properly mitigated. So these are perfect examples that business risk approach addresses during an audit. So both impact on the financial performance and disclosures are what the business approach looks at. So a key takeaway is that the audit has shifted from transaction-heavy testing to control-focused to also risk-based and now business risk-oriented. So take note of this. The current shift from transaction-heavy testing moves to control-focused, which is system-based, then to risk-based. Then currently it is more business risk-oriented. Business risk-oriented. So that's a key takeaway we need to employ. So each stage is to improve efficiency and focus, and also relevance in addressing real risks affecting financial statements. So it's not just the posting of financial statements, the numbers, no. We are gravitating towards the real business risk. What is affecting your business? How do you stay profitable? How do you stay afloat in this industry? How do you stay afloat in this sector? How do you keep your profits top notch? Not just after operations, they've posted financial statements. We don't even know what the bottom line is. We don't know what the result is, because systems and processes could be in place. Financial statements production could be okay, but the business is dying. Losses are accumulated. Earnings are eroded. Shareholder value, the value proposition is down. So that shift from just concentrating on financial statements production is a gradual shift that is in current form to help the business stay afloat, to help the business understand that whatever you are doing, we are interested in your existence and your future survival, is what this fourth parameter speaks to very practically. All right, so that's the end of the first unit on speaking to the development of audit strategy and practice. Do we have any questions, any contributions, any observations based on this
Yes,
Any
sir.
questions? Okay, yes, please.
Hello,
Please
sir.
go ahead. Yes, please.
I want to know this audit risk model. Is
Yes,
it
please.
also part of the factors to consider in choosing an audit approach? Is it under that, or is it?
Okay, good question. So, in understanding the audit risk model, it's not a factor to choose, but is an item when you are considering a business approach, a risk. It's not a factor because if you look at the risk-based audit, if you're doing risk-based audit, which is a current development for auditors, and for high-risk areas you want to concentrate, you need to use this model. So it's the approach that will determine the model you use, but it's not a factor. So if you are using the risk-based approach, you need to use the AR model, the audit risk model that speaks to the inherent, the control, the detection, or residual risk. So these are not factors; they are inputs under the risk-based model. Okay, I hope you're okay with that explanation.
Yes, sir. Thank you.
Okay, you're welcome. All right, so any other question? Good questions are coming, and I like the questions. Any other question? Okay, so let's look at the second section, speaking to the meaning of the business risk approach. The business risk approach. So, the business risk approach speaks to the fact that the business risk requires the auditor to view the entity as a whole and also assess the strategic and the operational risks that may impact the financial statements. So, like we spoke about business risk approach, the auditor needs to view the entity as a whole. So, he's not just concentrating on financial statements. And this approach is much more holistic and not in silo, just looking at the financial statement. So, strategic risk, operational risk that impact the financial statements are very, very important to look at. So, the steps in the approach speaks to number one, identifying key business risks. Key business risks. So the auditor needs to check risks that threaten the achievement of the business or the company's objective. Secondly, after you've identified or the auditor has identified the key business risks, the auditor needs to evaluate their impact. What is the effect of those risks if they crystallize? If those risks crystallize, what is their impact on the business? And that is, he needs to determine how these risks could affect the financial statements. Of course, the financial statements are the output, but then before the output, what could give a negative output? What could impact the financial statement negatively? And three, after evaluating their impact, he needs to plan his audit work around these risks. So, planning the audit work around these risks speaks to designing audit procedures and focusing on the most significant risks. Focus on the most significant risks so that he'll be able to appropriately have his opinion centered around these significant areas that will be of interest to the shareholders. So the key requirement for this approach is that it only works if the auditor has a deep understanding of the client's business and the environment. This is very important. So the issue around the business risk approach is that the auditor needs to have a key understanding, deep understanding of the client's business and the client's environment. And you will see that the ISA 315 speaks to this.
Your screen is not moving.
Okay, my screen is not moving. Oh, okay, it has frozen then. All right, let me work on that. I didn't even restart it when we went on break. That was the challenge. I'm supposed to restart it. I've overstressed the PC. We have 10 minutes to go. If I restart this system now, it may not come on till we end the lecture. Screen is actually frozen. Okay. Let me just share some thoughts, and I can't restart it now. It may not come on till we close, so we have less than 10 minutes more to go. So let me just share some thoughts on the business risk approach. So I was saying that this approach only works if the auditor has a deep understanding of the client's business and the environment, and is consistent with the ISA 315, which requires auditors to understand the entity. And that's why somebody was complaining that some of the auditors came to the business office and stayed 3 months, 6 months. I think it's a strategy for them to understand the entity and its business. So they need to be there to see how transactions are going on and be able to see physically, cite some of these things to identify risks of material misstatement. So an example of a telecoms company heavily on a small group of corporate clients is an example you could look at. So a telecom company that relies heavily on a small group of corporate clients, the business risk is around losing one of those clients, and that would significantly reduce their revenue. And in doing the risk assessment, the auditor needs to check the audit impact of that. The auditor can focus on the revenue recognition and disclosure of customer concentration, and those heavy small group of corporate clients would affect their going concern if they lost such a contract. So a telecom company can be assessed, or their risk assessment could gravitate towards those areas when an auditor is performing his risk assessment or business risk assessment. Then an example like an airline, we gave an example on the exposure to rising oil prices. The business risk around that is that fuel cost for airplanes and their volatility could affect profitability of that airline. So the auditor needs to assess provisions, hedging contracts, and cost disclosure to assess the impact of that on the client. So this is very key. And the key takeaway is that the business risk approach actually aligns with audit work, with real world risks. And it ensures that the auditor provides assurance that truly matters to stakeholders, not just the financial statements. The business risk approach is much more wider and holistic. And that is why ISA 315, speaking to identifying and assessing the risk of material misstatement through understanding the entity and its environment, is the international standard that guides the auditor in obtaining an understanding of the entity, which is very, very important. Obtaining an understanding of the entity, the entity's business model, the entity's operations, the entity's ownership, the entity's governance, and the likes. He also needs to obtain understanding of the entity's environment, macro and micro, the industry where it's domiciled, regulations that affect that industry, the economy, fiscal and monetary policies affecting the industry, then competitors, heavy competitors in that industry. He needs to obtain an understanding based on ISA 315. He also needs to obtain understanding of the entity's internal control system. Internal control system, very key. I know internal controls, the COSO framework speaks to some components. He needs to understand, based on the COSO framework, the control environment, speaking to the board and those that govern or make the apex and strategic decisions of that organization. So the first component of the internal control system is the control environment. Then he also needs to look at the risk assessment, how risk is assessed. The second component in the COSO framework is risk assessment. And the third one is control activities. Control activities centered around segregation of duties, division of labor, approvals, and hierarchy of authority, several controls around control activities. And the fourth one is information and communication. How information is shared in the organization, and also how communication is enhanced. Is there an organizational framework, organogram of the organization? How are the levels of authority are areas of information and communication? And finally, monitoring. Monitoring is also the internal control system the auditor must understand. Monitoring is a component of the internal control system. Are there internal audits? Are there internal control departments and all that? So he needs to obtain understanding of the entity, the environment, and its internal control. Very, very important. Then number two, very importantly, is the identification and assessment of risk of material misstatements. So at the financial statement level, the overall risks needs to be assessed. Then at the assertion level, speaking to specific risks affecting accounts, balances, and transactions and disclosures, he needs to identify and assess these risks based on the ISA 315 guide. And the third area is the design of audit procedures that will respond appropriately to those assessed risks. So where risk assessments have been performed, business risk, he needs to provide audit procedures that would directly respond to these risks. So the auditor's understanding of the business of the client is very important. And the key areas of understanding required by ISA 315, like we've said, is the industry, the regulatory and external factors, speaking to inflation, exchange rates, laws, then the nature of the entity. We've spoken about to that on the ownership, the governance, and the investments of that entity, its financing, and also the objectives and strategies and related business risk are areas to understand. Then measurements and review of performance, KPIs, critical success factors, budgets, variance analysis. Then the internal control environment, like I've spoken to the 5 components. So in rounding up, for example, in practice, imagine we are auditing a bank, say for example, and ISA 315, if we must apply it to understanding the banking system. A lot of us are bankers on the call. The ISA 315 requires us to understand the regulatory requirements, like minimum capital ratios, for example. We must understand regulatory requirements around that. We must also understand the economic environment of that bank, like, for example, the interest rate charges and charges. We must also understand business risks around credit risk. So banks do more of credit and credit transactions. So credit risks, cyber attacks, cyber security is an emerging risk currently for banks because they are high-tech. Their transactions are under the premise of high-tech systems. So business risk around credit risk, cyber security, cyber attacks, you must understand, or as auditing a bank, you must understand risk around this. Then internal controls around loan approval processes, amounts, the hierarchy of authority, the amount that can be approved at a particular level, and internal controls around IT systems. So based on this, we need to assess the risk of material misstatements in areas like loan loss provisions, revenue recognitions, or IT security breaches. So in simple terms and in summary, ISA 315 helps auditors understand the business first, secondly, identify the risks, then assess the effect on the accounts. Then also you need to tailor your audit work to those risks, which is very, very important. So that's generally what the meaning of the business risk approach is all about. Don't mind my screen that hooked, but at least I was able to share some thoughts on this business risk, because I'll restart my system later. So any question on this?